Building and increasing a business credit for beginners. Now I will give you 16 tips for creating a business loan. Building business credit as a beginner involves several steps, which mirror the process of building personal credit, but are focused on your business's financial activities. Here are some steps to help establish and build your business credit. Legal business entity. Create a legal business entity, such as an LLC, limited liability company, corporation, or partnership. This separates your business finances from your personal finances. Employer identification number, EIN. Obtain an EIN from the IRS. This is like a social security number for your business, and you will need it for most of the steps that follow. Business bank account. Open a business checking account in your legal business name. This will help you keep your business and personal finances separate. Business contact information. Establish a dedicated business address and phone number to ensure your business is listed in directories. This also further separates your personal and business identities. Business licenses and permits. Make sure that you have the necessary licenses and permits to operate legally. This contributes to your credibility when applying for business credit. Dun Bradstreet DUNS number. Register for a DUNS number, which is a 9-digit number used to identify your business credit profile. Credit with suppliers and vendors. Establish accounts with suppliers and vendors that report to the major business credit bureaus, Dun Bradstreet, Experian Business, and Equifax Business. Business credit cards. Apply for a business credit card that reports to the credit bureaus. Even if the initial credit limit is low, responsible use will help to build your business credit history. Pay bills on time. Always pay your bills on time or even early. Your payment history is a key component of your business credit score. Business credit report. Regularly check your business credit report to monitor your credit growth and to ensure accuracy of the information. If there are any errors, dispute them. Credit utilization ratio. Keep your credit utilization, the ratio of your outstanding balances to your credit limits, low to show that you can manage credit well. Credit relationships. Build relationships with more than one lender. Over time, consider a small business loan or line of credit to diversify your credit types. Monitor personal credit. While the goal is to establish business credit, many lenders will still look at personal credit scores, especially when the business is new. So, keep your personal credit in good standing. Financial statements. Keep accurate and up-to-date financial statements. This can prove helpful when you need to provide financial disclosure for larger lines of credit or loans. Educate yourself about credit. Understanding what impacts business credit can help you make better financial decisions. Learn about the factors that affect your business credit score and take actions that will positively influence it. Networking. Join a business association or networking group to learn from others and discover new opportunities for establishing and building credit. Remember, building business credit is a process that takes time. It should be managed carefully to establish a strong business reputation with lenders, which can pay off in the form of better loan terms and higher lines of credit in the future. The concept of credit history has roots that date far back in human history, but the formal system of credit reporting that we recognize today began to take shape in the 19th century. Before the 19th century, lending decisions were largely based on personal relationships and knowledge within communities. Lenders would make subjective judgments based on their personal interactions and familiarity with borrowers. The birth of modern credit reporting can be traced back to the 1800s. Mercantile agencies. The first credit reporting agency, the Mercantile Agency, was established by Lewis Tappan in 1841 in the United States. It collected and sold financial and moral information about businessmen, not consumers, and their ability to pay debts. These reports were subjective and contained various types of information, ranging from creditworthiness to personal character. Credit bureaus. In time, mercantile agencies evolved into credit bureaus that began keeping records on individuals, which contained a mix of factual information about payment histories and sometimes gossip about personal lives. Standardization and automation. The credit reporting system as it's known today began to take shape in the 20th century. During the 1960s, credit reporting started becoming more automated as technology evolved and agencies began using computers to store and manage data. Fair Credit Reporting Act. In the United States, the establishment of the Fair Credit Reporting Act (FCRA) in 1970 was a pivotal moment. This act provides regulation for the collection, dissemination, and use of consumer information, including consumer credit information. With the development of advanced computing and database systems, credit reporting agencies could collect, store, and analyze vast amounts of data on individuals' and businesses' credit histories. Today, a credit history generally refers to the record of a borrower's creditworthiness based on their past borrowing and repayment behaviors, as tracked by credit bureaus such as Equifax, Experian, and TransUnion in the United States. The system is now used worldwide and is essential for many forms of credit, including credit cards, loans, and mortgages. A business loan is a sum of money lent to a business entity which needs to be repaid over a period, typically with interest. Business loans serve multiple purposes, which allow businesses to fund their requirements, invest in growth opportunities, maintain cash flow, and cover other business-related expenses. Here are some common reasons businesses might seek out loans. Starting a business. Entrepreneurs often require funding to turn their business ideas into reality. A loan can cover the initial costs of getting a new business off the ground. Working capital. Loans can provide the necessary funds to cover short-term operational needs such as wages, rent, and inventory, maintaining cash flow, especially for businesses that have cyclical sales cycles. Expansion. When a business is ready to grow, whether by expanding its physical location, increasing production capacity, or entering new markets, it may seek a loan to fund these costly ventures. Equipment. Loans can facilitate the purchase of new machinery, vehicles, technology, or equipment needed to improve product or service delivery. Inventory. Some businesses might need upfront capital to invest in inventory, especially before peak seasons where inventory needs may spike. Refinancing debt. Businesses with existing debt obligations might take a new loan with better terms to pay off the older one, thus restructuring their debt. Real estate. A business might require a loan to purchase new real estate, such as a warehouse, office space, or manufacturing plant. Acquisitions. Businesses looking to acquire other companies or their assets might use loans to fund the acquisition. Research and development, R&D. Companies in technology, pharmaceuticals, or other sectors that rely on continual innovation may take out loans to finance their R&D programs. Marketing and sales efforts. Scaling a business often requires investment in marketing and sales, and a loan can be used for campaigns, hiring sales personnel, or expanding market presence. Safety net. Some businesses take out loans to have a safety net or cushion of capital for unexpected opportunities or challenges. Lenders typically offer various loan products tailored to fit these purposes, such as equipment loans, SBA loans, lines of credit, merchant cash advances, and term loans, each with its specific qualification criteria and repayment conditions. When considering a business loan, it's essential to carefully assess the business's financial health, the purpose of the loan, and the ability to repay it within the agreed-upon timeframe.